If the UK was slow into lockdown, it's coming out at a snail's pace. We've seen this with the ever so light touch easing of lockdown in May 2020, and warnings that pubs may not open until the autumn, nor the high street until Christmas.
Leaked documents published by the Telegraph reveal that the government have been preparing for a U-shaped recovery, rather than the V-shape originally hoped for by economists and by this channel. In short, that means a longer lag between the massive economic hit of the lockdown and the comeback. National debt and probably our taxes are set to skyrocket.
How we react and adapt as investors to this new world order will be key to our individual financial successes. You can't just tiptoe along anymore, imagining you'll sort out your financial freedom some year soon. The big opportunities are happening right now, as are the big dangers. This episode will cover two key themes. One, how to invest in the post-corona world, and two, what assets to invest in. We stress that none of the following is advice, but this is what we're doing. How you navigate these times could be what defines your portfolio for years to come. How should you invest in the post-corona world? Let's check it out. Welcome to MoneyUnshackled.com, the investing and finance channel that sets you and your finances free.
I'm Andy and that was Ben, and if you like what we say, hit the like button and click subscribe. Section 1. How to invest in the post-corona world. Watch out for a big drop. A constant trend of lockdown cost forecasting is that the price of lockdown is forever being revised upwards.
The extension of the furloughing scheme until the end of October by notionally conservative Chancellor Rishi Sunak and his magic money tree has made the markets question whether they still have faith in the UK market. They still do for now, but that might all change in an instant. Check out the effect of lockdown on borrowing. That big yellow bar that dwarfs all previous years is the realistic scenario. Let's hope we never see the red bar.
The assumption that we can afford these colossal costs depends on interest rates staying at record ultra lows, and as that leaked document suggests, by tax rises and wage freezes. If the market loses faith in the UK, then this could lead to a liquidity crisis and ultimately a sovereign debt crisis. The stock market would presumably tumble. Would you be ready?
Prepare your war chest. If you haven't already, it's time to start gathering the troops. Every pound of cash you have is a potential soldier in your investing army. If the markets crash again, you want to be ready with a war chest of monies that can be invested when prices are low.
We each have a pile of cash held back for such an occasion. Normally, holding a large reserve of cash worries us, because it's not being put to work to make us money. But when markets crash, that is the time when we'll be glad that we have the weapons in our arsenal to take advantage of the situation.
Drip feed. Having a large war chest of cash held in reserve does not mean that you can't be investing still now as well. Even if a second dip has not yet happened, market prices are still lower than they were before the corona crisis, particularly outside of the US.
Drip feeding regular amounts of money into the stock market is a good strategy at normal times and an even better strategy during a recession. The theory behind drip feeding your money into the markets is you end up with a reasonably low average buy price. You're not trying to time the market, which is very difficult to get right.
That said, if any world market takes a very obvious fall in any double dip recession, we will be ready with our war chest. But if that day never comes, we will still have been buying assets all the while throughout the recession at low prices by using a drip feeding strategy.
Section 2. What assets to invest in. Cash flow assets on hold. As investors fighting for financial freedom in our 30s, up until now we have been pursuing a strategy of investing for cash flow. Dividends from high dividend stocks, interest from peer-to-peer lending and rent from property.
This recession has put those things on freeze while we pursue a new strategy adapted to the times we find ourselves in. One of growth. Many companies have stopped paying out dividends to free up cash to help them survive through the crisis. This is very likely a temporary situation, and we fully expect the sweet dividend stocks that we already own to come back into play soon in the future.
Likewise, some peer-to-peer lending platforms have reacted to the crisis by lowering their interest rates. RateSetter cut its interest rates by half for 8 months until the end of 2020. Their Access account consequently now only pays 1.5%, which frankly is unacceptable, but perhaps a sign of the times we're in. On the plus side, they do still give you a £100 sign-up bonus when you open a new account using the link on MoneyUnshackled.com and deposit £1,000, which is something.
Finally, buy-to-let property is looking shaky at the moment. There's too much uncertainty that we'll be able to find good tenants with incomes to justify buying more of these right now. But keep a beady eye out for crashing property prices, which could change this.
Avoid REITs. While there has been positive signs that the property market is beginning to open up again, we are very sceptical about the long-term prospects of the commercial property side of the market. We think real estate investment trusts, or REITs, will take a sustained beating as it becomes obvious how well companies have coped during the lockdown, having their white-collar employees working from home.
There's no reason to pay expensive rents if your employees don't need an office. Where would that leave the prospects of a large city centre office buildings that underpin many investment REITs? At least REITs which focus on warehouses and factories probably are not going anywhere anytime soon. REITs with large holdings in mega warehouses like the ones used by Amazon should continue to do well as the economy shifts ever further towards home deliveries.
So what are we buying? We are focusing almost entirely now on the stock market. The holdings we have in property and peer-to-peer lending are welcome in our portfolios and are doing their job, but the stock market is where the action is right now. We've both been continuing to build our positions in our own handmade ETF portfolios consisting of ETFs tracking key regions including the US, UK, Europe, Japan, Asia Pacific and emerging markets such as China.
I've also been dabbling in defensive stocks in sectors like healthcare and other defensive assets like gold and Bitcoin. Gold traditionally does well in recessions and is doing well now. Defensive stocks are companies which do well both in recessions and in normal times, which produce essentials like medicines or food. I'm also picking up bargains where I see them, like the oil companies which took a beating in April.
Tracking geographies and sectors. If you keep an eye on the news, there are stories every day about some country or industry that has taken a body blow from the current economic crisis. As such, different markets are rising and falling on different days. The world stock markets are very volatile right now.
One day, America might announce some bad news and the S&P 500 index of American stocks could take a 5% fall. If it falls too far, we'll top up our holdings. When oil fell, I filled my boots. Next time, it could be the airlines or the banks. The reason we invest is not just because it has fallen, but because we think it has fallen too far. Stock markets are irrational, and when fear is rife, prices often tank far too much. The key is our instrument of investing, ETFs.
ETFs invest in an entire index, which will often contract when there is bad news about a country or a sector, but will rise again when the bad news passes. Individual companies in those indices may indeed go bust, but it doesn't matter too much to us because we're not buying the individual stocks, we're buying entire markets.
The future's bright. As ever, we are optimistic about the future. One day, this will all be over and markets will be back up again.
We want to know that we took advantage and invested well during the days of opportunity, and in the future our portfolios will thank us for it. Investing is a long-term game, but in times of recession we have to be savvy about short-term opportunities.
And realise that it is possible to time the markets in the broadest possible sense by investing more heavily when markets crash. Question of the day: do you see this recession ending anytime soon? Let us know in the comments below.
Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.